What about Fannie and Freddie, which still hold $5 trillion in mortgages? Neither are addressed in reform. Isn't that a major, major miss by lawmakers, Alan?
Well, I don't think so. I think actually, interestingly though, Fannie and Freddie illustrate my point about monolines, right? So everything you do to say just stick to your knitting instead of diversify, if all you do is mortgages for a living, you're more likely to go over the cliff in mortgages than if you have a choice. That didn't stop everybody, but it certainly creates an issue. I think Fannie and Freddie are in a category by themselves and are going to have to be resolved directly by the government. And I don't think that Fannie and Freddie fit a definition of the way normal financial institutions work. So I don't see how they have their own regulator. I think they're going to have their own way of being resolved, and I'm not sure what that is. But I do think that financial reg, which is trying to deal with how the whole system will be going forward, can't anticipate where they're going to fit.
So they shouldn't have addressed Fannie and Freddie.
I don't see how they could have.
They're going to have to address Fannie and Freddie. But not as part of this regulatory reform, is what Alan's saying. I agree with that. Fannie and Freddie are so large, they're going to require their own form of addressing, and there's some very tough issues there, right? You can't let Fannie and Freddie go out of business because there's nobody else to take their place. That would knock the housing market in this country right off its pins. That can't be allowed to happen. So that's going to require its own separate, distinct, focused set of discussions and resolution.
What about the risk, Alan, in the mortgage market right now? I know Guggenheim recently made an acquisition, Bulls Capital. Is it related to Fannie and Freddie? I mean, is there a lot of opportunity out there or a lot more risk?
Well, I think there's still risk inherent in housing values, but I think that there are opportunities where we're focusing on is the opportunity to provide liquidity to mortgage dealers who are originating mortgages that fit the current Fannie and Freddie guidelines. Like everything, after the crisis, usually the mortgages or whatever is created, loans after the crisis are generally pretty good. And so it's just providing liquidity to those who are going to create the types of loans that Fannie and Freddie legitimately want to create in today's environment, and bringing that to the kinds of dealers who don't have easy access to liquidity while they're packaging them up for Fannie and Freddie.
What about Dick City's position when it comes to mortgages? I mean, there was a $75 million settlement with the SEC in terms of subprime position in 2007. That's been taken care of. How does the portfolio look now?
Well, the pre-existing portfolio is obviously probably our biggest single issue in terms of the cleanup that's been going on in the city for the last couple of years. In terms of what we now call city holdings, the biggest single category of assets would be mortgage assets. And, the housing market is still struggling, let's put it that way. But are we abandoning the mortgage business? No, we're not abandoning the mortgage business, because you can't have any kind of retail aspirations if you don't have that product. So the underwriting, and actually, interestingly, loans that were underwritten, through the city system by in city branches or by city personnel, have held up fairly well. It was the loans that were acquired from mortgage bankers and others, and then that got trapped in the warehouse, sort of when the curtain came down, that we're having to struggle with right now. But there's going to be a mortgage business, and there has to be a mortgage business. There's going to be a housing market, right? And so we have, as all of our peers have, we've tightened up our underwriting. We've eschewed a lot of, but not all, of the broker-generated mortgages, and we're continuing to be active in that space because, frankly, that's what banks do.
Well, and as a consumer-facing bank, the city is more and more.
They provide credit to people who want to buy homes or buy cars or pursue businesses. That's what we do.
It's all about consumers now. Consumer Protection Agency. It's a big sticking point. It's through. We don't know who's going to lead it. We know it will be housed in the Fed. Alan, I thought it was interesting. Last year you asked the question. You said, can we innovate the way in which the products we create in the marketplace actually enhance the productivity of society? So have the products that are out there changed? Are they changing?
Well, I don't know if they've changed yet so much. I think they likely will. I think that, this is all, though, one big cycle. Dick talked about it earlier. You got to get all of the pieces to fall into place, right? So It's interesting, now in the new bill, if you're going to underwrite loans, you have to retain some of the risk.
5%.
That seems like such a natural thing to think about. If you're going to underwrite, you want to own some of the risk. Yet, as I say, the previous regulation was driven towards, wouldn't it be better if they could offload the risk and still be in the business of creating things? That didn't realize how that would shift the dynamics so much. I think, the key now is really getting to the point where especially small businesses can feel confident in the outlook for overall regulation, for tax policy, for health policy, for all of these issues, to feel comfortable that they know the rules of the game and that they're going to be rewarded if they innovate and do well. And then I think there are going to be a lot of products that I think the markets are looking. Large corporates aren't demanding a lot of capital these days. And so if you're not going to just lend against existing assets, what you need is legitimate demand for capital to innovate, to create new businesses, to create new products, and that's what drives the dynamism of the economy. I do think the financial system is really anxious to meet that demand. I think the key now is stimulating that demand.
And also, when it comes to consumer protections, Dick, at Citi, what moves are being made? What dramatic changes, if any, have been made to fall in line with the Consumer Protection Agency?
Well, I don't think we've made any dramatic moves to fall in line with the Consumer Protection Agency. First of all, it's brand new. As you say, there's still a
lot of questions.
A lot of ground to be sort of tilled there before we know what sprouts. We supported it. We think that responsible banking requires a face toward the consumer that you're serving their needs as opposed to serving your own or operating in a kind of proprietary way. So that what we've done is we've restructured the bank to take a lot of the either proprietary kinds of activities or activities that don't go to the heart of the consumer that we're trying to serve and put them into this thing I told you about before called Citi Holdings, which is in sort of wind down and sell-off mode, and then focus in the core bank on responsible banking targeted at both large corporate customers and at consumers in a responsible way.
What will it mean? Well, you both run very different firms. I mean, Citi's in the public eye, Guggenheim isn't. So to both of you, Dick, first with you, how will consumer protection, the new agency, when we see how it plays out, how do you think it will affect Citi's bottom line?
Fortunately, I don't run Citi. I'm out of running things anymore.
You and Vikram.
But, Vikram's my guy. He's a good man, and he's got a hell of a job in front of him. But we talk about it all the time. And I think that as I said, we were behind the move to create a consumer focused entity down in Washington, because what happens is a lot of times the very products themselves are impenetrable from the point of view of understanding. And I think the real purpose of this entity is to make sure that products that are put in the market actually do what they say they're going to do and say what they're going to do in sufficient clarity that people can actually understand it and make intelligent judgments. Really? So we're all for that, and we've tried to do that ourselves, so we think compliance will be, for Citi, not a very difficult task because we weren't trying to fool people in the first place, and the focus is on customers and on consumers. But I think that's going to be the real mandate of the consumer agency, to sort of say, does this product do what it says it's intended to do, and is there enough clarity and straightforwardness about the description that people can sort of understand and make judgments in their own behalf? This is what I need, this is what I want.
So you don't think it'll cost Citi money in the end?
Well, regulation costs money. That's a
outside
truism.
of that, overall.
Regulation costs money, but I don't think it's going to crimp our business, no.
What about you, Alan? A different firm, a smaller firm, more nimble. What is financial reform and consumer protection? How does that affect you? Does it benefit you in any way, or is it just the new law of the land, the new rules?
Well, I think the more likely outcome is if we can think intelligently that whatever the changes are in the landscape, if you have the opportunity not to have a very large existing business which is being re-regulated, we have a very good business, but most of it isn't affected by the new regulations. So it creates opportunities to say, where are the dislocations? Because as we've been talking, no matter what set of rules you create, there will always be something that you didn't anticipate that happens because of that. And trying to find where there are inefficiencies that now get created just creates opportunities to say, okay, there's now an opening. There are a lot of entities that get created to do things. Remember, on these consumer protections, I'm all in favor of them. And I think better disclosure is a good thing. But remember, there was a big drive for 20 years by the regulators to make sure that higher risk credits were not denied credit. Well, if it's higher risk, it's going to cost more. And now there's a recognition that not everybody who's a higher risk credit should actually get credit. That maybe it's not a good thing for them to say, let's make sure they get access to the same credit as anybody else if they're not really in a position to handle that credit. So, a lot of dislocations occur. There's a lot of businesses that get created to meet the mandate of a prior regulation. Those businesses sometimes are disintermediated. Now all of a sudden, the circumstances of the marketplace say, well, gee, there's nobody now providing the real credit to the people who really should or deserve access to it. Trying to fill in some of those gaps. There's new products that get created, and that's what we're going to try and do.